Hello and welcome to this final podcast of 2024 from the Moneymakers. I'm Jonathan Davis. And this podcast, exceptionally, I am actually recording it as a video because there's some charts and things I'd like to show. It may make that a little harder for you to follow if you are doing so purely by listening in on audio, but I hope to make it as clear as possible. So here we go. This is December the 23rd, 2 days before Christmas. And the subject of the podcast today, I've got no guests. I'm just going to be talking about the recent announcement last week by Saba Capital, the US activist hedge fund, which has announced that it is requisitioning votes to change the management at 7 of the investment trusts in which it has built up a significant shareholding or at least interest through derivatives over the last couple of years. So here goes. This is an important development, I think, for the sector, has wider implications. And this is really the purpose of today's episode, is just to summarize what's been done, what's been said, and to look at the performance of these particular trusts. So I'm going to kick off now by switching to look at the 7 trusts which have been the subject of these requisition moves by Saba Capital. So here we are. These are the 7 trusts in question, and we just have quickly run through who they are and what they do. So I'm going to rank them first of all. Using this, I'm going to rank them by market capitalization. So here we've got Herald Investment Trust. This is the longest serving, one of the longest serving managers in the UK investment trust sector, managed by Katie Potts. Invests in technology, has backed a lot of technology companies in the UK over many years, and is the largest of the trusts, which is the target of one of these requisition votes. Before I go any further, I should perhaps say that what a requisition vote is. This is when a shareholder has more than a particular percentage shareholding in the company, they have the right to requisition a vote of the entire membership, all the shareholders, and that's what Saba Capital has done. In these 7 investment trusts, it has an interest of a shareholding or a derivative position that gives it economic exposure to the trust of between 19 and 29%. These are significant stakes it's built up over the past couple of years, and it's using that shareholding to requisition the vote, and the board of directors has no option but to accept that requisition. And what they are asking is for a general meeting to be held at the earliest opportunity, no later than February, at which they will put forward a resolution saying that the existing board of directors should be replaced, and 2 directors from Saba Capital should be put in their place. To succeed, they need to win more than 50% of the votes at the general meeting that will have to now be called. And of course, the merit of that from Saba Capital's point of view is that it's a vote of those who turn up to vote. It's not a vote of all the shareholders. And so they need to win 50% of the votes cast. And with their own stake of between 19 and 29%, they are in a good position to win that vote, given that many shareholders traditionally, and in particular private investors, do not vote in these general meetings. So effectively, it's going to be possible for Saba Capital on the day to throw out the existing board of directors and replace them with its own 2 nominees if it wins just over. If the turnout is 50%, it's already well on the way to winning these votes. So it's using a partial shareholding to achieve a significant change of control in these trusts. And I think that is important. It's a tactic that this particular activist fund has pursued in the past, and it is, as we'll see, perhaps you could say taking advantage of the complacency of existing shareholders, but it is the law, it is the way the corporate law operates and the listing particulars operate. And if they succeed in winning these votes, then they will be able to put their 2 nominees on the board, replacing the existing board. And then they say they're going to review options for the future of these trusts, and then shareholders will be given the option of whether or not to agree with these new plans that Saba and its representatives will be putting forward. And it's worth saying at this point that one of those options they've said quite clearly is to actually appoint Saba Capital itself as the manager of these trusts. They say they're going to look at ways of realizing liquidity for existing shareholders, and there will be some mechanism for shareholders to get out somewhere close to NAV, they say. So that is an opportunity for shareholders too. But the follow-on from that is that Saba Capital may well be proposing itself as the manager and looking to combine these particular stakes that it will then have in these trusts and adopt a new strategy similar to their own strategy of buying shares which are trading, or funds rather, which are trading at wide discounts. So this could potentially be a complete change of mandate for the existing shareholders. And they will then therefore be offered a choice between exiting at some value, or if they fail to vote, or fail to follow through, they will end up in a fund managed by Saba Capital, or that seems to be the strategy. So if you like, what this is an attempt to do something for shareholders. I think that's fair. They will get some opportunity, but also perhaps this is an asset gathering strategy, something which Saba Capital has done before with two American funds, one managed by a company called Voya, the other managed by Franklin Templeton. And those two funds were both effectively taken over by Saba Capital and now run as funds with this particular objective, I said, of buying stakes in closed-ended funds which are trading at a discount. And we'll look a bit more at that in a moment. But anyway, here are the 7, which are now the target of these requisition votes. And Herald is the largest, and been around, I think, for a long time, long-serving manager, Katie Potts. And as you can see, one of the arguments that Saba's making is that it has been successful in causing the discounts on these trusts to narrow. And it's been doing that in part by just continuing to buy shares in the trust right up to the moment of its announcement last week. Well, here are the other 6. We've got Baillie Gifford US Growth Trust. That's around 800 million. Edinburgh Worldwide Investment Trust. This is also another Baillie Gifford investment trust, which invests in global smaller companies. And like a lot of Baillie Gifford's growth-oriented strategies, has been having a pretty rough time. Had a particularly strong performance after the pandemic during that huge post-COVID surge, if you like, that affected all the Baillie Gifford trusts in particular. They all went soaring to new highs, including Scottish Mortgage, its biggest trust. Edinburgh Worldwide is its global smaller companies trust, but since then it's been a pretty unhappy experience. And next, we've got the European Smaller Companies Trust. This is managed by Janus Henderson and does what it says on the tin. That's another 660 million market cap trust. And then we've got 3 smaller trusts, Keystone Positive Change, managed by Baillie Gifford now, which took over this trust and changed its name a few years ago and empowered it, or adopted a new mandate to invest in what it calls positive change securities. In other words, these are companies that will have beneficial impact on the world. That was popular at the time, or that seemed to be popular at the time because of the whole ESG movement, but it's struggled since then. Keystone has struggled since it took on the mandate. And then we've got 2 other smaller trusts, CQS Natural Resources Growth and Income, which is an independently managed company. And then we've got Henderson Opportunities, also managed by Janus Henderson. Market cap now just 91 million. This trust has also been around for a long time. Invests is a UK all-cap strategy, so small and mid-cap and large cap it can invest in. And that's another Janus Henderson trust. So we've got 3 Baillie Gifford investment trusts in this group of 7. We've got 2 managed by Janus Henderson, and then we've got these other 2, which are independent, so Herald Investment Trust and CQS Natural Resources Growth and Income. In all these cases, you can see, as I said, that the discount has come in. This line here shows how the discount has moved, and it has come in virtually to zero in the case of Henderson Opportunities Trust. It's actually just around 1.5%, I think, today. But again, this has been on a roller coaster ride, big recovery after COVID, and then in line with smaller companies generally, a very weak period, some sort of recovery recently, but the discount has come in thanks to the buying from Saba Capital, among others. So these are the 7, but it's worth making the point that these are not the only trusts that Saba Capital has built up its shareholdings over the last 2 years. We can look at a much bigger list here. I'm just going to switch this to, so this is Saba Taka. These are all the trusts in which Saba has built up a position of more than 10%. The ones we just saw, the 7, it has between 19 and 29%. But these are all the trusts that it has a stake of more than 10%. It also has some which is between 5 and 10% and therefore have to be disclosed. But let's just look through these. So here at the top here, we have the ones we've already mentioned. All these ones at the top here are the ones in which it is seeking action until we get down to BlackRock Smaller Companies. That's 624 million. JP Morgan European Discovery Trust, that's 516 million market cap. European Opportunities Trust, which was the first trust which faced a public campaign by Saba Capital, and was the board there introduced a series of measures as a response to that, and that's still a trust in which Saba has a much smaller stake now. The Montanaro European Smaller Companies Trust, Schroeder UK Mid Cap, Montanaro UK Smaller Companies Trust, Littlefield Canadian Income Trust, Crystal Amber Fund, and River and Mercantile. So, which is a microcap trust which has a market cap of just 16 million. So, as I said, this is not just those 7 trusts, but those 7 trusts are among the largest that, or at least several of them are among the largest that Saba Capital's built up a stake. It says it has a total investment of around 1.5 billion in these trusts, but including these derivative exposure that it has, it's carrying greater weight than that. So overall, we're talking about trusts with a combined market capitalization of over 6 billion, in which it is seeking to introduce changes. So what can we say next? Well, the next thing perhaps to look at is going to be what Saba Capital says it's going to be doing. So this is the letter that Saba Capital and its CEO, Bose Weinstein, a New York hedge fund manager, has sent or has published, appealing to all the shareholders in these 7 investment trusts where it is requisitioned a general meeting to vote out the existing board. So the 7 we've mentioned already, Baillie Gifford US Growth Trust and so on. We call these general meetings because the current boards have failed to hold the investment managers accountable for the trust's wide trading discounts to NAV and their inability to deliver sufficient shareholder returns. And Saba holds an interest in between 19 and 29%, as I said, making us the largest investor in each trust, aligning our interests with yours and giving us the right to requisition the general meetings. We believe that the boards have not minded the trading gap, which is why we want you to offer you the opportunity to elect new directors with a concrete plan to deliver shareholder value. The only thing worth saying here is that by holding between 20 and 29% effectively, Saba Capital has built up an important dominant position on the share register, but it is not looking to take its shareholding beyond the 30%, because at that point it would be forced to make a bid under takeover rules for the whole company, and it's not prepared to do that. So it is acting in its own interest. It says it's acting on behalf of all shareholders. Well, I think it's pretty clear that its primary objective is to make money for itself, and that will be either by creating opportunities to realize value immediately, or by acquiring assets through, if you like, some would rather, I'm sure the trust will say through the back door, allowing them to take control of the assets of the whole trust and earning fees on that going forward if they're successful in appointing themselves as the managers of the residual assets in these trusts. It's a tactic that Saba Capital, as I said, employed before in two other funds. And next up, the Bose Weinstein goes on to talk about his past working for Deutsche Bank, where he mainly invested in a variety of credit strategies, and explaining what caught his attention is that the wide discounts in the UK investment trust sector, which of course we're all very familiar with, having discussed many times over the last 3 years. Key point here is their suggestion that the boards have not held those managers accountable. It says Saba prefers private engagement with the boards of trust investing, but underperformance, persistent trading discounts, and disengaged management teams leave us no choice but to act. Well, again, as we'll see, what's happening now is that the boards of these various trusts will be hard at work coming up with how they intend to respond to this aggressive tactic from Saba Capital. I think they have put out statements saying that shareholders should do nothing until they do respond, which is standard procedure. And some of them have been pointing out that they have made some steps to try and bring in discounts over the last couple of years. But there's going to be effectively a public battle between the boards and Saba. And a lot of it will turn on whether or not boards have actually done enough to prevent these wide discounts first opening up and then persisting in a number of cases. I think one of the things we'll hear from the boards is that will say that they have tried to engage with Saba privately, as Saba says it wants, but they found it very difficult to make progress. That's to be their story, and it's going to be something that we can test and see as the weeks go by. Though I think it's fair to say that some of the advisors to the trust have been moaning quietly that they're now going to have to work all over Christmas because they have to put out they have to call this vote and get ready to put out their response by the very first week in January, which doesn't leave them much time because of the holiday period. And I think that's, again, part of this sort of classic activist technique. You make these challenges to the boards just before a holiday period. That reduces the amount of time they have to rally support and get their defense, if you like, in order. So this is a hardball strategy being pursued by Saba Capital, no doubt about that, I think. So it talks about Saba's past, what they've done, and then they put some data in here about performance. It's important to note the trust discounts in NAV have narrowed significantly over the last 6 months. We consider this to be a direct result of Saba building our total stake in these trusts to 1.5 billion. This is the 7 trusts that they're talking about here. Without such buyer demand or the prospect of active steps being taken, there is a risk of the trust's share prices falling and discounts widening again if we are unsuccessful in our pursuit to reconstitute the boards of the 7 trusts. So these are the figures that they're going to rely on. They're sticking to 3-year performance figures. They're pointing out the average discount, double digit in every case, and looking at the shareholder return versus the benchmark. And it's fair to say that if you chose that particular period, the 3-year period, which takes us back to just before the Russian invasion of Ukraine, when the investment trust sector generally was trading at a premium. But since then, those 3 years since then, as we know, have been very significant. The average discount has widened from around 2% to now 16%, which is under 16% as of today. And the share price performance, total shareholder return, this is rather, I should say not share price performance, total shareholder return against the benchmark, the figures are looking very bad. Of course, all this needs to be placed in some sort of context, and that will be one of the strategies that the boards will be pursuing. They will look at different performance periods, no doubt, particularly over 1 year. They'll say, well, we've actually done much better over 1 year. And they will say, this is a Saba putting its the worst they're putting the performance on its worst foot forward, if you like. But there are some pretty shocking underperformances here, particularly from the Baillie Gifford Trust USA. That's Baillie Gifford USA, Keystone Positive Change, and Edinburgh Worldwide. Those are the three Baillie Gifford Trusts. They've all underperformed by around 40%. Whereas in other cases, it's not so extreme. And in the case of Herald and European Smaller Companies Trust, well, the latter's actually outperformed over the 3-year period, even though its discount does remain right at around 13.5%. That's one of the Janus Henderson trusts. And Herald also has underperformed its benchmark, but by a much smaller margin. The takeaway is clear, say Saba. The trust managers and their directors have failed shareholders. They've not taken sufficient steps to resolve the trust's structural issues, depriving shareholders of superior returns. While there are multiple levers to narrow these position discounts, inaction has been the consistent course of current leadership. Well, I think that's not entirely true. We do know that a number of boards, some of these trusts have announced plans. So, for example, Keystone Positive Change, the board there has put forward its own proposals to offer shareholders either an exit or a rollover into a fund, another Baillie Gifford open-ended fund that pursues the same strategy, the positive change strategy, and they've brought that forward. But that was only quite recently, but they have taken that action. But you have to wonder whether that's too little too late, precisely because Saba has built up its stake, that they have been prompted into doing that. Why did they not do that a little bit earlier? That will be the challenge that they face. Similarly, Hot Henderson Opportunities has also put forward some proposals just the other day for offering solutions to shareholders. But again, this, the Saba will say, well, that's been the case for most of the last 3 years. Why has it taken you so long to get to this position? And so on. I think in the case of European Smaller Companies Trust, they will say, well, look, we have actually outperformed over the past 3 years. And the fact that our discount is at 13.5% is, well, that's in line with, general experience at the moment. But could they have done more? That's going to be what the battle of this is all about. So what are Saba then proposing? 2 critical resolutions: to remove all the current directors of the trusts, and secondly, appoint new highly qualified candidates to replace them. Well, the list of candidates is here. There's Bose Weinstein himself, but he's only being proposed as a director of one of the trusts. That's the Baillie Gifford USA Trust. And then there are a number of others. Paul Kazarian is one of Bose Weinstein's right-hand men, and he's been proposed for all the other 6 trusts. And then there are some other proposed directors here, most of whom won't be familiar to UK investors, but they're all presumably those who've worked with Saba in the past in some format. They are described as independent, but we will see. Though no doubt the boards, as their response, will focus on some of these directors and say what do they actually bring to the party. They're not names that are familiar to most UK investors. So what is the plan? Our plan is simple. With a reconstituted board, we intend to provide shareholders with long overdue liquidity options alongside the opportunity for greater long-term returns under a new investment strategy and manager. So the new directors will transparently assess all go-forward options, including liquidity events, tender offers, share buybacks, so that all shareholders immediately have the opportunity to receive substantial liquidity near NAV if they wish. Well, we'll see how that plays out. If they do win control, will they offer all shareholders the opportunity to receive substantial liquidity near NAV? How near NAV will that be? The issue for many shareholders in some of these trusts, having been shareholders for quite a long time, is that if they are institutional investors, they are going to face capital gains tax if they actually realize their shareholdings. And some private investors may also face the same issue if their holdings are not in ISA or SIP format, tax sheltered structures. So That's going to be one of the issues. But if they do what they say, then in theory everybody will be able to get out. That would be something. Terminating the trust's current investment management arrangements and replacing the trust's current investment managers. So there will be, if they win control, there will be no option to carry on under the existing mandate, at least as far as this appears to be setting out the future arrangements. And refocusing the trust investment mandates on pursuing discounted trusts and or combining them with other investment trusts where appropriate to realize scale benefits and synergies. So in other words, they're going to take the trust that they take control of, and then they're going to change the mandate, sack the existing managers, giving them notice, it should be said, over different periods depending on what the terms of the mandate are, and then they are going to replace them with Saba's own managers and change the mandate to a discount strategy, looking for opportunities to buy other discounted trusts and funds. This is something that Saba already does. It says, we've seen demand from investors to bring a product similar to our CEFS exchange-traded fund, which actively invests in discounted closed-end funds to the UK market. This campaign answers this call. Well, it's not clear how many investors actually have been showing interest in a strategy of this kind, but we'll no doubt that will be something else that the boards will zero in on in their response. At each trust, the board will be changed immediately, and each new board will consider the optimal investment strategy. So they'll give notice, as I said, 3 months, 6 months, or 12 months, depending on the agreement. New arrangements will be considered put in place before its expiry. We intend to propose Saba as the new investment manager to each of the boards for their consideration. And if they do that, they say Mr. Weinstein and Mr. Kazarian will recuse themselves from voting on board decisions related to Saba. So that'll be interesting. To ensure compliance with the higher standards of governance, intended that one or more further independent directors will also be appointed to each board as soon as reasonably possible following the Trust General Meeting. Well, that's interesting, isn't it? The higher standards of governance. They're going to appoint more independent directors. But who will be choosing those independent directors? Well, presumably it's going to be put forward by Saba itself. So if the newly reconstituted board selects Saba as the new investment manager, we intend to deliver attractive terms and greater value by shifting the trust's investment mandates to focus on purchasing discounted trusts consistent with our successful strategy, as investors have consistently called for. Well, I don't think I'm aware of many investors having consistently called for this particular mandate, but that's obviously part of their plan. That's why I say what it appears to be is, you could argue, is a asset gathering strategy by the back door. So that is what Bose Weinstein and his colleagues have had to say. So let's now go back to looking at at what they've actually done themselves. So this is the closed-end fund ETF that Saba's talking about, what it is saying, the kind of thing it wants to create for investors in the trust that it is targeting. Saba closed-end funds ETF. It has $239 million of assets. And if we look at fact sheet, yeah, we can look at its performance, so you can see what it says. This is the actively managed ETF, which was set up in 2017, in March 2017. So it's been going for 7 years, and the annualized return since inception, it says, is 11% in NAV terms and just under 11% in market price terms. Interesting enough, this is marketed as being a trust that generates high income. Here we are. This is what they are proposing. This is the example that they've setting up, that they've been running for the last 7 years, and they claim has been very successful. So that's the ETF, but we can also quickly look at a couple of the funds that they are running as well. These are the two other funds that they manage which are relevant: Saba Capital Income and Opportunities Fund and the Saba Capital Income and Opportunities Fund 2. Now, these are both, as I mentioned before, these are both originally funds, open-ended funds managed by two American investment firms, Voya and Franklin Templeton. Then let's look at this first one. This is the Voya, was originally the Voya fund, and that was taken over by Saba in June 2021. The fund itself originated in 1988. Here's our friends Bose Weinstein and Paul Gazarian. And this is the performance, but this is performance summary. It's not particularly helpful in this format because, as I said, they only took this over since Saba's inception. It was in 2021. So the 5 and 10-year figures are not particularly relevant. They only show that the fund before that was performing pretty poorly, which is why they got the opportunity to take it on. And they're claiming since they took it over the return of around 8%. 8.4% NAV and just under 8% in market price. So continuing to trade at a small discount, you can deduce from that. This trust itself, this fund itself has been trading at a small discount. So that's number one. That's the first fund, the Voya fund. And then if we go back, we should be able to go back to the other trust. I can't find the second one, but the second one they only took over at the end of last year. Forgive me for that. Franklin Templeton Fund, and they took that over with effect from January this year, and they are claiming that's around $264 million, and they're claiming a return of 24% since then, year to date. So that's a pretty strong return in line with actually the S&P 500. So these are obviously they're going to be pointing to these the performance of their funds. Which these particular two funds, they don't just invest in discount opportunities, they also invest in loans and bonds and all sorts of other things. So there's a mixed strategy in these funds, unlike the investment trust ETF. So let's go back then to looking at these, the performance figures of these particular trusts, because a lot of this will turn around, what effectively the board has been doing and how good the performance has been in share price and NAV terms. And, well, there's not much room for argument that these trusts have not performed brilliantly over time. I think that's pretty clear. But a lot, as always, depends on what you take as your starting point and how much account you take of the prevailing circumstances. So let's just quickly first look at the discounts. I mentioned that already, but here's Herald. Has always traded on a significant discount. We can take this one back at least 10 years. And you'll see it's always traded at between 10 and 20% discount. That's been normal. It's partly the nature of the trust. It's partly the fact that it has a lot of early stage technology companies in there, has a lot of holdings, a lot of unlisted holdings. And one of the questions going to be that I think will be thrown back at Saba is from Herald and also from some of the Baillie Gifford trusts, which have built up significant private holdings, not just publicly listed holdings, is, well, what are they going to do with those private holdings? You might, for example, vote for a return of capital, but how are they going to do that with significant private investments in the portfolio? That won't be necessarily easy to realize. So that will be, some have suggested that maybe Saba Capital really haven't thought this through. They've got these unlisted holdings. What are they going to do about them? Well, we'll see. But that's certainly been a factor in the discount, I think, on Herald. Let's look at Baillie Gifford. Well, this is a very different story, of course. Baillie Gifford US Growth Trust. It's been on a roller coaster, put it that way. It did trade at a premium for quite a significant period, as you can see. But since 2022, in line with investment trust sector generally, it moved to a big discount. It started to come in the about a year ago, which is around the time that Saba began to build up its stake. and has come in significantly since then. But the question is, how much is that due to what Saba's buying, and how much is that due to what the board has been doing? Has the board been active enough in share buybacks and so on? Well, each of these seven trusts is going to put forward their case. They're going to say we have been buying back shares and to what extent and so on. And they'll be talking about some of the other general issues that have affected the investment trust sector. But it's worth, as I said, making the point that Saba has been busy buying these shares right up until quite recently, and USA, this one is one in particular where it's been buying shares right up to this point. So it's actual. We don't quite know what its in cost is overall. Well, at least it's possible to calculate it maybe, but that's not publicly available at the moment. But they have been bringing in the discount by their purchases, and will use that to argue that the discount has come in because of their involvement. And I think that's true to some extent. Can't disguise that fact. But there, as I say, this is a trust that didn't used to trade at a discount, but has done more recently. Edinburgh Worldwide, similar sort of story. Small cap, generally rarely trades at a premium, but this trust had a very strong performance over a long period before COVID and then immediately after COVID, and went to this, what in retrospect appears to be quite an absurd peak when there was that effectively post-COVID relief rally. And since then, the shares then traded for a period of about 3 years at a premium, and the trust was happy to issue some new shares. That again will be another talking point. You were happy to issue shares when they were trading at a premium, but when it moved to a discount, you haven't bought back as many. And since then, we see it went to a big discount, has come in again, and is now trading at around par. The European Smaller Companies Trust is slightly different from the others in the sense that it has actually outperformed its benchmark even on Saba's own figures, but it has been very volatile. There's no question about that. Has been very volatile, and very rarely traded at a premium, often between 10 and 20%. And so I think that's also going to be one of the issues that Saba Capital is going to raise. They're going to say, well, look, this trust has always traded on a discount. You didn't do anything about it. You never have done anything about it. Why not? And I think there's a legitimate argument there. Could the board have done more to better marketing? Could they have done more buybacks and so on? If you talk to someone like Peter Spiller at Capital Gearing, he says these discounts are voluntary. You can always go on buying back shares until you've eliminated the discount, in theory. And in this case, where the discount has been persistent over 10 years, you might argue whether that's really the board has been a little bit asleep at the helm. Keystone Positive Change. Well, this has been an interesting story. As I say, the mandate change that took place, I think it was around 4 years ago, has not been a success. Except initially, when they first took over, there was this little spike in demand, and the shares traded quite close to par. Since then, they moved out to a discount, and the strategy has not proved a great success. This trust is subscale, and although the board has moved to offer a rollover and return of capital, is that a little too late? I don't think you could argue that this one has not been a success, unfortunately. CQS Natural Resource Growth and Income, another slightly different vehicle, specialist vehicle. Again, has always traded at a big discount, averaging around 15-20%. Is that good enough over a long period? Again, quite small, 120 million, now subscale. And finally, Henderson Opportunities, which again has always traded at a discount, except perhaps briefly in this one period here, post-COVID. And has chugged away, has permanent gearing, which has made it more volatile. But its long-term record is not fantastic. And again, now subscale, managed by James Henderson and Laura Fall at Henderson. They have other trusts that they manage, and the question is, well, does Henderson Opportunities really add anything in particular? Does it do anything distinctive? What is it about it? How will the board defend itself here? I think that's an interesting question. So if we look, though, at how these trusts have performed over the last, well, let's say, first of all, let's look at year to date. The numbers don't look too bad, as we can see. But if you look at the chart, it gives you a better context. Bailey Gifford US growth is up the most, but it's also fallen the most. So, 54% gain sounds terrific. But if you think it's still below where it was trading back here in 2021, it's those short-term numbers can be very deceptive. No doubt we're going to hear a lot about short-term performance from the boards in their response, but you need to put this in a longer-term context. Other trusts, Herald is up 25%. It's been obviously a good period for technology trusts. It hasn't done as well as some of the big tech exposed trusts, Saba Capitals and Allianz, but it has, over time, over the last 10 years, you could say it's put in it has performed relatively strongly, and I'm not sure that I'm sure they'll be able to make a defense of their performance looking at a longer term context. Edinburgh Worldwide, well, that has been distinctly underwhelming. The board has now responded, but maybe they should have responded earlier to the clear underperformance. Henderson Opportunities I've already mentioned. That's share price up 15% year to date, almost entirely due to discount narrowing. CQS, Natural Resources Growth and Income, I say a specialist sector. You could argue here that the shareholders knew that this trust has exposure to the commodity world, and that's by its nature very volatile. And one of the functions of investment trusts is to provide so-called patient capital, so that you can invest in assets that are perhaps more volatile, more risky, but you're patient, have the patience to see it over a period of time. That's one of the arguments for investment trusts. And I think what this whole episode underlines is the fact that if you defend investment trusts because of their capacity to provide patient capital, well, or permanent, semi-permanent capital, well, we now know that is not really been the experience of the last 3 years. Almost every trust has had to respond to the discounts that have opened up. And if you believe that discounts should not be allowed to persist, then you are, if you like, knocking a big hole in the whole permanent capital thesis. So it's a balancing act to get this balance between allowing shareholders and investment managers to look after shareholders over longer periods of time and give them the opportunity to see through short-termism and short-term volatility against the fact that shareholders actually can see through, with discounts widening, they can see their returns falling and being disappointing compared to alternatives. So this is really, that's why I say this is something of a kind of seminal moment for investment trusts. We are seeing a lot of trusts have already disappeared. Others are still in the process of either winding up or merging and so on. And so we are going to see a significant culling of the investment trust universe. And I don't think you can argue that's necessarily wrong, indeed. But in the short term, you can say, well, there are always explanatory factors. But in the longer term, you have got, I think 3 years is a decent period of which to say, to hold a board to account as to whether or not the discounts should have persisted that long, or whether they have been too complacent in not getting round to acting quicker. As we saw last year in 2023, we saw a number of trusts taking preemptive action. I'm thinking, for example, of a sort of role model might be JP Morgan's mid and small cap trust getting together. That was announced at the end of last year, and that's gone through, and that's been successful. But they acted quicker than a number of other boards and other fund management houses. The Keystone Positive Change has been disappointing even with that help from Saba's buying and the discount finally coming in a little bit. That's clearly, I think, was destined for the exit. And European Smaller Companies Trust, well, that's, I think, the interesting one. I think of all those that we've talked about, the 7 here, the 2 that are deemed to be most likely, I think, maybe to see off Saba Capital are this one, because of its generally stronger, beaten its benchmark, stronger performance. It provides something that invest shareholders in the trust might actually decide they value. That's one, and I think Herald also will be able to put forward a very good argument for survival. Katie Pott's been around a long time, a lot of admirers. She's stuck to what she does. She's very passionate about what she does, and you can argue that she's doing something for UK technology companies that is generally worthwhile, and the longer term returns are not insignificant. So I think those 2 are those that the city seems to think have the best chance of surviving. But, and it is a big but, the question is, notwithstanding that, the fact that Saba Capital has been able to build up this significant shareholdings in these 7 trusts, and these 2 in particular, means that whatever the board may now say, or whatever the shareholders generally may say, it may be too little too late. You have to think that Saba will think they've got a good chance of winning the vote, requisitioning the meeting, and will get more than their 50% of the vote that turns out. So unless the boards and the managers can get the shareholders to turn out and to vote against Saba, they are going to be disappearing. And notwithstanding in a couple of cases that, I say, you could certainly make a case that they deserve, or at least should be given a chance to survive. So, and if that is the case, that they disappear, despite having, credible records, I think that will be seen as something of a smash and grab raid by Saba Capital, in which they're going to end up with, if you like, lining their own pockets at the expense of those shareholders who are suffering because they couldn't get the vote out. So it's a very important moment, I think, for the investment trust sector. It's an important moment for Saba Capital. It shows that they have got a strategy. We don't know what their strategy was originally when they started building up the stakes. Maybe they just wanted to be, to get a tender offer and to be able to realize a return, which they made some money out of some of the trusts they've been involved in so far. But clearly they can see a different prize here. And they could argue that's out of frustration that the boards haven't done more already to placate them. But I think we're going to hear a lot of war of words going on and talking about vulture capitalists, and all those kind of strong language will be wielded. But it all comes down to the vote, and it is perfectly legal to do what they are doing. If they requisition these meetings and they get more than 50% of the votes on the day, they will have succeeded. And it may then be that some investors will be happy to take cash or whatever other options they're offered. But there will be plenty who maybe find themselves ending up in a Saba Capital vehicle, which is definitely not the mandate that they originally invested in, and which they may or may not feel is a better outcome for them. So that's where we are. If we look at the premium and discounts quickly, we can sort on this measure. We can see that they've all come in sharply, as I've said. But you could perhaps argue those discounts remain wider, for which I would include the European Smaller Companies Trust, 7%. That suggests that they have perhaps the most chance of seeing off the Saba vote. And Keystone positive change of 5%, 5.5%. Well, that may be because the board's proposals are already going to go through, and most shareholders may decide that that's a better outcome for them than going into this Saba Capital lottery, so to speak. So there's a lot to play for. We will see. And I should remind you also, as I said, that there are many more other trusts in which Saba has a stake. And if they succeed with these ones, where they have the biggest holdings, who's to say they won't then come back and go after the second division, if you like, where they have between 10 and 20%. or more in a couple of cases, and try and repeat the medicine. It'll be so we're going to kick off next year, 2025, with quite a lot of corporate action. It's going to be quite a hairy time, I think, quite exciting time for the investment trust sector, but some fundamental questions remaining about the future of a number of trusts and whether or not boards have in fact been sufficiently active to prevent this kind of outcome, which in the short term, though, may well provide benefits for a number of shareholders who have become frustrated by the long drawn-out discount widening process of the last 3 years. So that's it for this particular episode. I've gone through it in some length. I don't know whether that's of value or not, but it's something that I think which every shareholder will want to think about over the course of the holiday period. I'd like to finish then by wishing everybody who's supported the Moneymakers podcast and the newsletter for the last 12 months, and wish them a happy Christmas and a prosperous new year. The markets are looking pretty toppy in some ways, equity markets that is, and bond yields are being firmer than many had hoped. There's clearly some issues to be resolved. So it's going to be a fascinating year, and I look forward to sharing your company on this journey over the next 12 months. So that's it from me, and be in touch again soon.